Hi, I'm Amit Premchandani and I'm here to talk about UTI, Banking and Financial Services Fund. Banking and financial services has strong linkage to the underlying macroeconomic environment. It is one of the few pure plays of the domestic growth story. As on May end 2022, we have exposure across the financial services space with 74% exposure to banks and 26% exposure to non-banks. Within banks, we have around 64% exposure to the private sector bank, while in the non-banking space, we have around 12% exposure to NBFCs and housing finance companies. Among the non-lending space, we have around 14% exposure. The fund is managed with the following themes: asset quality. Post the pandemic, banks provided relief to their borrowers through moratorium as well as multiple form of restructuring. Although what we have seen is that the pressure on the salaried segment was pretty muted, while MSME and self-employed segment saw higher stress, but was still manageable. At the end, FY22 actually saw the lowest credit cost in last 5 years, and we expect even FY23 to be pretty benign in terms of credit cost. Market share. The underlying theme of significant market share movement in favor of private banks and select NBFCs continues from public sector banks. However, the pace of this shift in market share will decelerate as credit growth normalizes on the corporate sector. The fund is also focused on the retail deposit franchise of the banks. As in a rising interest rate environment, retail deposit becomes much more important, and many lenders try to secure their deposits to take care of the M&A transaction that they have already announced. Growth. We expect growth to revive on the credit side, and we are already seeing double-digit credit growth with corporate credit growth reviving on the back of working capital loans. Some shift is also expected from the bond market as interest rate increase due to RBI action. Retail credit growth is expected to be in mid teens, largely driven by mortgage and personal loans. Most of the lenders in the portfolio have very strong retail lending franchise. Finally, we have also seen the trend of financialization of savings, and we have around 14% exposure to this theme through insurers, mutual funds, and financial intermediaries. These players have very long runway for growth, very little capital requirement, very high ROE. The only risk is in the form of regulatory risk. Also, the threat from the fintech appears to be ebbing, with investor demanding profitability rather than focusing only on customer acquisition. This will, we think, will accelerate the partnership between traditional banks and new age fintechs. In summary, we think BFSI as a space has a very long runway for growth. Competition is ebbing, margins are stable, and there is a list of very high quality liquid investable names. An investor should look into this theme as a part of their allocation. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.